The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, we had a decent end to the week in the corn market on Friday with a little bit of follow through after a nice outside day higher on Thursday. We were up around a nickel across the board on Friday's session, a little more mixed in soybeans and wheat, more strength in soybean oil, and a mix to higher end of the week in cattle and hogs as well. Let's take a look at these markets and get analysis and perspective today on the show from Kent Beadle with Paradigm Futures. Welcome back to the program, Kent. It's good to talk with you again. How are you?
I'm doing great, Jesse. Thanks for having me on the program.
Absolutely. Well, let's just dive into the grains first, and just to summarize the week in the trade, I think, before we dive in a little more deeply here, as I kind of mentioned, a decent end to the week in the corn market, a little more mixed in soy and wheat. What jumps out to you as you take a look at how things just closed out the week, Kent?
Well, I mean, a few things. First of all, higher weekly closes in both corn and soybeans, not dramatically so, but at least higher. Kind of mixed in the wheat. I think the KC and Minneapolis markets actually ended up posting higher weekly closes as well, with Chicago fractionally lower. For as bearish as the trade has become, and with all of the increased production estimates that you're getting out of South America, being obviously one of the reasons for the bearish sentiment, the other being the incoming administration and the worries about trade policy and tariffs and all of those things. I mean, you have to say that we probably held up fairly well. One of the things that you point to for a higher weekly close is just the ongoing strong demand that we continue to see, and we had a number of data points on that front this week. We had a very good oilseed crushing report that came out early this week, well above trade expectations. A decent ethanol grind as well, although maybe not quite as good. But looking under the hood on the ethanol grind, you find out that, they've got an awful large implied yield that may actually end up requiring a revision higher in the actual number of bushels of corn used to get that size of production. They ended up doing that for last month. We think that could happen again. Then you go to another decent week of ethanol production on the weekly report, off of the record from the prior 2 weeks, but still very good. And then excellent export sales reports again. And one of the surprising things I think that we saw this week was that in addition to a couple more weekly or daily sales announcements of soybeans, either to unknown or to China, and of course the soybean oil sale to South Korea, which is soybean oil is a whole nother story. But there were rumors in the cash market that Sinograin was buying soybeans, not just for January, but they've been buying for February and are now buying U.S. beans for March. And we're not competitive against Brazil for March, but we're seeing that those beans are being procured. It makes you wonder if, number one, are they starting to try and stockpile some soybeans, the government entity, and are they buying them on terms that might possibly shield them from any tariffs that may change in the interim? Don't know the answer to those questions, but I think the sources as to that those sales are getting made are fairly reliable, and we just keep seeing really, really solid export sales on the soybean side. A year ago, we were already, I think, 3 or 4 weeks into declining export sales in soybeans, and we're still humming along at a near record pace.
Yeah, I wonder in the corn market, I want to dive in there a little bit deeper with you here. We were chatting about this before we went on the air. Uh, Corn this past week, I know, got through some moving averages. It's testing some overhead resistance levels now, especially that March contract, but even looking out to DC 25, et cetera.
Yeah.
I have to wonder. I mean, we're at some pretty cheap levels here. Some folks who are still bearish in this market are wanting to, they're trying to say that we might go lower, but I mean, are we cheap enough, Kent? I mean,
Yeah.
talk to us about this right now.
How cheap is cheap? Because
Yeah.
there are a lot of bears out there in the marketplace, and you have to go back and ask yourself the question: what's the function of price? And in the case of cheap prices, what are the function of cheap prices? And the function of cheap prices are twofold. Number one, they're to increase demand. And then number two, they're meant to potentially constrain future supplies. In other words, to influence decision making on what you plant and how much you spend on the crop that you do plant. All right. So going to the first category, which is the demand side of the equation, as we were just talking, demand has been terrific. All right. And the truth is, it's been terrific now for many, many months. If you go all the way back to the USDA balance sheet, for example, in last February and March, we were carrying out, we're forecast to carry out over 2.2 billion bushels of corn.
Mm-hmm.
We ended up at 1.7 and change, right? That was all demand increases that occurred over the course of the summer. And that strong demand is carrying into this year's crop. We had a great crop, but you watch average basis levels in the United States, and you watch the corn spreads, and you see, holy cow, and I hear from clients in different parts of the Corn Belt that say, man alive, there was a lot of corn piled up here in, between October 15th and November 15th, and those piles are disappearing pretty fast. So from the standpoint of, is this price influencing demand and increasing demand and doing the job that low prices are supposed to do, you can check that one off. We're doing that. So then you have to ask yourself, what is this price going to do to future supply? And you look at the situation. I'll start with Brazil. Obviously, we don't know how many safrinha acres they were going to plant, and we were concerned about that early on. We're still concerned about the fact that the sum total of fertilizer imports to fertilize that crop, we believe, is still down year over year. And then we look ahead to the U.S. crop, and we have to look at cost of production and what do the economics for both corn and soybeans look like going forward. And just a couple weeks ago, the USDA put out their estimated cost of production for the average U.S. farmer. And it came in at about $825 an acre there, plus or minus. Mm-hmm. I'm going to increase trendline yield from last year's USDA 181 to 182.5, and essentially we come up with a break-even price for the American farmer on average at $4.81, which is actually very similar to where last year's break-even price was. And currently we've got these corn at $4.37 settled today. So we're 44 cents a bushel underneath break-even costs. I go back and I look at history, and I look at December corn futures going all the way back to 2007, and looking at that continuation Dees chart, looking ahead, just considering it as a new crop price against USDA forecast cost of production. And we've never been 44 cents under cost of production in the month of December or in the month of January and February. In fact, the cheapest that we got was 49 cents under 49 cents under in, 39 cents under in 2020, and we were already kind of revaluating everything because of COVID at that point in time. So, so you might say, well, gee, that looks pretty bad. Well, what about soybeans? And based on soybean cost of production, which are something closer to 625, and I think the corn might have been 875. Forgive me, but I think the soybeans are 625. I'm going to increase or put a 52.5 bushel yield on it, and we get to 1195 ish type break even number for soybean production, and we settled today at 1005. We're nearly $2 a bushel underneath cost. Gross dollars per acre break evens we're about $85 below cost on $85 an acre below cost on corn, about $110 an acre below cost in soybeans, and that's going to have an impact. Now, people say, well, you're not, the acres are going to get planted. Well, most of the acres are going to get planted, but the marginal acres may not. Okay, and you're going to find some acres are going to find its way into conservation programs, and you're going to find acres that may find its way into some other alternative that might pencil out a little bit better. But my guess is you will see lower acreage for both corn and soybeans this upcoming spring, and I think it could skew more toward beans because there's less costs you can take out of beans. What might happen is that we plant less acres of beans, and if we do see some of those acres flow into corn, what's going to happen with those corn acres is that we're going to spend less money on them. Okay, because we have to also focus on not just the decision that the U.S. farmer is going to make with these terrible prices, but what is the decisions that are going to be made by the American banker that are lending money on an operating line to these growers. And I just think less money is going to get spent. And so whether it's less acres or it's less money being spent on the crop, which ultimately translates into lower yield, that's where this price right now is going to have an impact on next year's production.
Kent, great thoughts and analysis, and that's going to be something to definitely watch over the next several weeks ahead and months ahead, is just how this all shakes out for planting in the U.S. coming up this spring. You mentioned earlier bean oil in itself is an interesting market. I should ask you about that. World veg oil values have just been on fire, it feels like, here as of late. So talk about what you're watching fundamentals-wise in the bean oil market right now.
So some of this is being driven by palm oil and concerns about production. Palm oil futures prices up over 50 now, which we made new contract highs here again this week. Set back a little bit on Friday, but still consolidated the new contract highs we made on Thursday. There's been La Nina concerns about production that have been ongoing here for a number of months, and now just recently they had significant bout of rainfall that put some of the plantations actually underwater, and they're even more concerned now about production in palm oil. What it's done is it's taken the value of palm oil, which is typically one of the world's cheapest vegetable oils, and put it to I think a 10 to 15% premium to the value of soybean oil. And so, what has that done for soybean oil demand? Well, we are now at over 150% of the current USDA export estimate, and we are only 2 months into the marketing year for soybean oil. That marketing year starts October 1st. So clearly what's going to happen is that the USDA is going to have to adjust upward soybean oil exports significantly. They will adjust downward the carry-out stocks, obviously, to some degree, and they will probably have to reduce domestic demand to some degree as well. all of this is happening with a backdrop of the Chinese pulling its rebates to exporters of waste oil out of China. That happened here a couple of weeks ago to begin here on December 1st. And of course, then you have the potential for that waste oil to even become more expensive if tariffs go up on general Chinese imports. And then you have obviously the situation with Canadian canola oil and what would happen with that if under a different tariff regime, if President Trump would decide to go in that direction. Mm-hmm. And even if they don't, you have to wonder if, there's a movement afoot that we hear about within Congress to remove all imported oils from that particular tax exemption, for the production of renewable diesel. And of course, that would then just increase soybean oil demand to a point where then the function of the market is going to be to not reduce soybean acres, but to try to get some of them back into production.
Sure.
It's a very, very interesting time in which we live. Of course, we say that pretty much all the time. Yeah. It's not a particularly fun time. This is a down cycle in agriculture. We all know it, but we're not lacking for things to talk about and things to look at. That's for sure.
No, we are not, definitely. I better ask you a protein sector real quick as well before we close it out here today. Yeah. Decent recovery in feeders. More mixed in the fat cattle on Friday. Cash trade perked up a bit at the end of the week. Hogs, a decent close there. Any big notes for you in the protein sector, Kent?
Well, just the demand, I think, is the demand for protein products at these higher prices has just been much higher than I think many people thought that we would be able to maintain. Okay. Yeah. There's been all of this concern about the health of the American consumer, whether or not, we were going to move into some sort of recession, which we seem to be trying to avoid. We had a good jobs report here again today. And, all things being equal, the demand for protein has held up very, very well. We know that we've had issues with cattle supplies and cattle slaughter. Total slaughter still down about 3.6% year over year. And yet we've had 100% of cattle numbers in feedlots over the entire course of the year, which obviously means that there's less cattle out on the range. There's more cattle in feedlots, and there's a reason for that because they're making these cattle bigger. They're feeding them out heavier, which is one of the drivers for this strong corn demand. So it all ties back there. But this is all being driven by strong demand from the American consumer.
Absolutely. Kent, if folks want to reach out to you and talk about their risk management and more there at Paradigm Futures, how could they get in touch with you?
Yeah, we can be seen at www.paradigmfutures.net, and our contact information, phone numbers are all there. I'd be happy to hear from you.
ParadigmFutures.net for more. With that, Kent Beadle, always good to chat with you, sir. Thanks so much for being with us on Market Talk today, and we'll get you back on the show again real soon.
All right. Thank you, Jesse. I do appreciate it.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.